If you think that gold is a foolproof investment, think again. From overpaying to falling for scams, one wrong move can turn a safe asset into a costly regret. So in this video, you'll learn the 7 most common gold investing mistakes and how to avoid them so that you can invest smarter, not harder. One of the biggest mistakes new gold investors make is not understanding the different ways that you can invest in gold itself. It's easy to picture, gold bars or coins and think that that's the whole story, but the gold market is actually much more diverse than that. First is gold ETFs, or exchange traded funds. These are shares that you buy in the stock market that represent a certain amount of gold. Now, they're easier to buy and sell. They don't require you to worry about storage, but they do charge annual management fees. So there's physical gold bars, coins, or even jewelry. Those are all classic choices. It's tangible and it feels secure, but it comes with responsibilities like safe storage and insurance, plus dealer markups and storage fees that can eat into your profits. There's also gold mining stocks. Those let you invest in companies that mine gold rather than the gold itself. These can be more volatile though, since their value depends on both the price of gold and the company performance. And then there's digital gold, which allows you to buy fractions of gold online with a company holding the physical gold for you. It's convenient for beginners and those who really don't want to deal with storage, which is the biggest pain point for physical gold. Each type of these has the pros and cons, so take the time to learn about your options before you actually buy. And picking the right type for your goals and risk tolerance is the first step to avoiding costly mistakes. So now that you know the different ways to invest in gold, let's talk about why skipping research and due diligence is such a costly error. So rushing into gold without doing your homework is a really fast track to losing money or just getting scammed. So just like you wouldn't buy a car without checking its history, you shouldn't buy gold without researching both the seller and the product itself. And the gold market, it has plenty of reputable dealers, but also its fair share of scammers. In fact, the FTC has reported a rise in gold investment scams, including, fake websites and counterfeit gold being sent to unsuspecting buyers. That's why it's crucial to stick with well-known dealers who have strong reviews and are accredited by organizations like the Better Business Bureau.
To play devil's advocate, some lesser-known sellers may offer better pricing, but that comes with extra risk. Just make sure you're not trading trust for a tiny discount.
A very good point, Tiara, and if it seems too good to be true, it probably is, so make sure that you're careful. Research also means knowing the current market price of gold before you actually buy. Because gold prices, they fluctuate, and if you don't know the spot price, you might end up overpaying. You can check sites like the World Gold Council for real-time prices. Also, verifying authenticity is essential. Reputable dealers provide certificates of authenticity and details about purity. If you're buying from a private seller, make sure to have the gold tested by a professional. Skipping these steps can actually lead to you getting ripped off, buying fake gold, or just paying way too much. So take your time, do your research, and make sure that you're getting the real deal. On a side note, with gold or really any other investment, staying informed is your best defense. So make sure that you subscribe to stay ahead of all types of different investor rookie mistakes, because I'll try to stop you from making them. That said, once you've done your homework and found a trustworthy source, the next thing to watch out for is overpaying or ignoring hidden fees. Now, it's easy to get caught up in the excitement of owning gold, but fees and markups can quickly shrink your returns if you're not careful. When you buy physical gold, you almost always pay more than the current market price, which is the spot price. Dealers add a premium to cover their costs and essentially make a profit. These premiums can range from 2% to 10% or more for collective coins. So for example, if the spot price is $2,000 for an ounce of gold, you might end up paying $2,100 or more. Now, gold ETFs, those charge annual management fees, usually around 0.25 to 0.40% of your investment. And over time, those fees can really add up and eat into your gains.
Did you know? Some collectible coins carry premiums of over 20%. That's a huge hurdle to break even.
I definitely didn't know that, Tiara, but yeah, 20%, it is a heck of a lot for what you're getting. Now, storage and insurance are other costs to consider as well. So renting a safe deposit box at a bank, that can cost you $50 to $200 a year. And private vaults, those, they'll charge more usually. Now, you can avoid these altogether by keeping it at home, but you should realize that your homeowner's insurance might not cover theft or damage of gold unless you buy a special policy. So always factor in all the costs, the premiums, management fees, storage, and insurance before you buy. That way you won't be surprised by, hidden expenses, and you'll know your actual return, not just those surface numbers. Next, let's look at why details like gold purity, certification, and storage need your attention. Overlooking the importance of gold purity, proper certification, and secure storage can seriously hurt your investment. Gold purity is measured in carats or as a percentage. So 24 karat gold is pure, while 18 karat gold is about 75% gold. You also always want to check for the purity stamp of 0.999 or 0.9999. Those numbers mean that there's higher purity. And higher purity means higher value and easier resale. Certification is just as important. So reputable dealers, they provide a certificate of authenticity, verifying the gold's weight and the purity. Without this, you risk ending up with counterfeit or underweight gold. And counterfeit scams have really increased, especially online, so always demand paperwork. Physical gold needs to be kept somewhere safe. So stashing it at home, it is risky. And we already mentioned that standard homeowners insurance, it often doesn't even cover high value gold. So many investors, they'll use bank safe deposit boxes or even private vaults. And again, those will come with fees and access limitations as well. If you're investing in digital gold or ETFs, storage is handled for you, but make sure that the provider is reputable and fully insured. Now, once you've got those basics covered, let's talk about another big pitfall, which is trying to time the market and letting your emotions really take over. Gold is known as a safe haven when the economy gets shaky. Whenever there's news about inflation, recessions, or a stock market crash, people rush to buy gold, hoping to cash in. But trying to time the market and making those emotional decisions is a classic mistake. Gold prices, they are unpredictable in the short term. So for example, recently gold hit an all-time high, but it's also fluctuated quite a bit week to week. If you jump in during a panic, you risk buying at the top and watching the price fall right after. Emotional investing can also lead to panic selling. So imagine you bought gold during a frenzy, and then prices dip and you sell to cut your losses, locking in those losses. Or maybe you get so excited about gold's potential that you put way too much money into it, thinking it's a sure thing. Well, spoiler alert, there is no such thing as a sure thing when it comes to investing, even with gold.
If you buy at a peak and it drops 15%, that could take years to recover unless prices rebound quickly.
Yes, and this is the right way to think about it. A seemingly small mistake can be a massive long-term problem. A smarter approach is to invest gradually over time using what they call dollar cost averaging. That means just, buying a little gold at regular intervals so that you're less affected by price swings. It's a way to take emotion out of the equation and stick to your plan. Speaking of plans, another mistake that goes hand in hand with emotional investing is putting too much of your portfolio into gold and completely ignoring diversification. Getting caught up in gold hype can lead to putting too much of your money into gold and forgetting about diversification and really the fundamentals. Diversification means spreading your investments across different asset stocks, bonds, real estate, and gold so that you're not putting all your eggs in one basket. Most financial advisors actually recommend keeping gold to about 5 to 10% of your overall portfolio. That way you get the benefits of gold as a hedge against inflation and market downturns, but you're not overexposed if gold prices drop. One other thing to remember is that gold doesn't pay dividends or interest like stocks or bonds. So if you go all in on gold, you might miss out on the growth and the income that other investments do provide. The only earning that could really come from gold are if the price of gold rises. So there's a big opportunity cost in any gold investment. Don't fall into the trap of thinking that, gold is a magic bullet. Use it as one part of a balanced portfolio, not the whole thing. Now, even if you've got your gold allocation right, there's still one more mistake that can trip people up, and that's not having a clear investment plan. Jumping into gold without a clear plan is like heading out on a road trip with no map. You might end up somewhere interesting, but you're probably not going to reach your, where you actually want to go, your true destination. So think about why you're investing in gold. Are you looking for a long-term hedge against inflation? Are you trying to protect your wealth during market downturns? Or are you just hoping to make a quick profit from different price swings? Your answer should shape how much gold you buy and what type it is. So whether it's physical, ETFs, mining stocks, or digital gold. There are things that you can do to help with this though. So set clear targets. Maybe you want gold to make up 7% of your portfolio. And if gold prices jump and it grows to 12%, you might want to rebalance by selling some gold and buying more of other assets. This helps you stick to your plan and avoid getting too heavy in one area, which would be gold. Also, regularly review your investments. So the gold market, it changes, your financial goals might shift, and what made sense last year might not work today. So set a reminder to check your portfolio at least once a year and make adjustments as needed.
Just a quick tip from Tiara here. Set calendar reminders to check your gold allocation every quarter. It makes it easier when life gets busy.
I'm completely with Tiara on this one. So I check everything in my portfolio once per quarter just to make sure that it makes sense. That said, before you buy your first ounce or click purchase on a gold ETF, take a step back and map out your goals, your risk tolerance, and your exit strategy. That's how you use gold as a smart tool for building wealth, not just a really pretty and shiny distraction. But what's the best way to invest in gold without taking on more risk than you should? Well, in this video right here, we'll break down the safest and riskiest ways to invest in gold so you can choose the option that fits your goals.